I'm here today with Andy Wood from ETC Tax. Andy is here to talk about tax considerations for your clients when business exit planning. Say hello, Andy.
Hello.
And I'm ready to get started. Welcome, Andy. Andy, over to you, and
Brilliant.
enjoy.
So hopefully everybody can now see some slides. Morning everybody. Thus far, I think we've got to just after 9:30, and I've not yet seen any government U-turns on tax policy just yet. But of course, the day is young in these rather strange times we live in. So this is, as advertised there on the screen, it's a talk broadly on the tax considerations for entrepreneurs, business owners, when I guess one or two eyes on exit, or more broadly, or more broader sort of succession planning. So we're going to look at sales to third parties, so a trade sale, as it were. But we'll also look at other alternatives as well, because there are other alternatives. So we will look at potentially bringing in employees, or employees taking over the business, and also in the context of a family business, can we bring on the next generation as well? So essentially give the shares to the chip off the old block, as it were. So it's really, I'm really delighted to be here talking to you guys, with thanks to Tams for that. But for what it's worth, I'm Andy Wood. I'm a barrister and tax advisor, and I've got certainly, I think you stop counting, don't you, when you get to 20, but I've got 20 years tax experience advising high net worths and entrepreneurial individuals, so quite active people, I guess. So there's quite a lot to talk about. I think I've probably covered those 3 points already. Sale to third party, sale to employees and management, and transferring the business to the next generation. So there's quite a bit here. So let me stop waffling on and crack on. So I'm going to try and cover these areas with a case study of Sir Willy Wonka here, who, as it says there, is a successful confectionery entrepreneur. He owns 100% of the shares in Wonka Chocolate Limited. He's had a valuation, for whatever purpose, it's around £10 million. As you can see, it's not the first time Mr. Wonka has attempted to put in place a succession plan. His first one didn't go very well. He'd spoken to Mr. and Mrs. Twit down at the golf club, and they'd suggested him that he passed on the business to whoever found a golden ticket in his chocolate bars, and that was a fair disaster for him, and ended up with a number of negligence actions from parents of variously mutilated children from going around his factory. However, business is thriving, so he's now again turning his mind to succession, but this time he's going to take professional advice, maybe from one of you guys listening in. And I think as a generational divide, we've got, depending on your vintage, you will see, you will view Willy Wonka as a left, or if you're sort of more recent, you may view Johnny Depp on the right as Willy Wonka. So either way, you're covered here. So here are his options. First and foremost, he's had some interest from a conglomerate, Cranky Pharmaceuticals, as we can see, started off in manufacturing and selling medicines, but it's essentially grown much bigger than that, and acquires businesses in much a more varied area, and they're interested in making a purchase of Wonka Chocolate Limited. So we'll have a look at how that deal is coming along in a minute. He's also been wondering whether he might be able to transfer some or all his shares to his loyal Oompa Loompa employees. First and foremost, because Sir Willie runs his business with a strong sort of ethical ethos, and he thinks that they are going to be the most likely people to carry on. One of his concerns about cranky pharmaceuticals is that they may be essentially corporate raiders, and they may not steward his legacy quite so well as his loyal employees. Finally, we're going to look at whether Sir Willie has family members who might want to carry on his legacy. So first, as a preliminary step, I think it's always worth looking at some of the considerations which a business owner might look at prior to a sale, because I think the more planning and the more time that a potential vendor takes, I guess, managing this process, that quite bluntly, the better price they may get for it. So I know I'm probably preaching to the converted here, but what they'll be doing will be looking to sort of maximize earnings. So that will be increasing margins where appropriate, but also, I guess, having a real review of expenditure, and particularly expenditure which is only going to benefit the business in the long term. Could that be axed to improve the profitability of the business? The lead time, is a case of how long is a piece of string. When do you start planning this process? And it will depend on a number of factors. So, firstly, what is the economic climate? Clearly, you can't do a great deal if a pandemic comes along, and in a recession, that might also delay matters. So that's one factor. Other market trends should also be taken into account. What is happening in the confectionery business? What are the prospects for that sector, I guess? And then what is the general merger and acquisition activity, I guess, both in the sector and more generally in the economy? Clearly, the owner is going to be wanting to demonstrate a number of key points. For example, he'll want to show a potential purchaser that the business has strong fundamentals. A purchaser will be looking for strong and committed management team, and also we want to demonstrate that there are good financial controls there. I think reputation is also something which needs to be sort of cultivated as well. So things like having a strong brand in the market, having a real good sort of connection with your ideal customers or clients. Increasingly, a tax profile or tax reputation as well is something to consider. We've seen how reports of I guess let's say creative aggressive tax structures has affected the reputation of a number of large multinational businesses in particularly, but a much smaller entity that's had historic tax problems, you're going to see that perhaps a potential purchaser will be chipping on the price and maybe wanting increased warranties, might be wanting money to be put essentially retained or put on escrow or something like that, as more sort of skeletons potentially come out of the woodwork. So they were just some preliminary matters. I think also maybe tidying up the balance sheet as well. So things like if you've got, I guess, as is often the case, we see business owners running their company as a personal piggy bank. So using assets in there, using credit cards, personal expenditure. So quite convoluted sort of loan accounts, things like that. But also if the company has essentially bought investments, has surplus cash, those things, it might be worth removing those prior to any sort of, I guess, active marketing of the business. So just a little bit of housekeeping there. So let's look at the first option here, the potential sale of the business to Cranky Pharmaceuticals. So Willis Colding as advisors, Boggis, Bunsen Bean, and they've sketched out an overview, I guess, of the position following the expression of interest. And the meeting, as put there, goes a bit like this. So they set out really the two main options here, and the two options broadly are that we can look at either a sale of shares in Wonka Chocolate by Sir Willie to the potential purchaser, or alternatively, Wonka Chocolate can sell its business and assets, business assets and trade to Cranky Pharmaceuticals. So if we follow that through, sale of shares is likely to be preferred by Sir Willie, mainly because this will enable him to potentially lock in business asset disposal relief on a disposal. It also avoids a double charge, as we'll see. A sale of business assets is likely to be preferred by the purchaser, by Cranky. This is mainly because they don't acquire any historic problems attached to Wonka Chocolate Limited. So any further action which comes out of those negligence cases or something like that, if they buy the assets and business rather than the shares, then they're not, I guess, acquiring those historic issues. So that is what the purchaser is likely to require. However, ultimately, it will depend. So the eventual will depend on who has the whip hand in any commercial negotiations, and that really is the crux of the matter.
Andy, sorry, just before you move on, there's a quick question, and I know I can give an answer once if you say no, but Helen's asked, are you going to be discussing share buyback options during this?
No, we're not now.
No, that's fine. A bigger subject on its own, but Helen will be putting the details of how you can contact the team at ETC Tax at the end. So I'm sure Pete will be happy to discuss it with you if you need to.
Yeah, I mean, it's an option in these circumstances, but just in the time we've had to sort of had to have some boundaries in terms of the topic that we discussed. But no, I'm afraid we're not going to.
No, perfect, thank you.
Okay, so an asset sale. So as you remember, this would be the purchaser's favoured route. So, sorry, I've got some updates coming in on my computer, blocking off the screen. In terms of an asset sale, a preliminary step, it's going to be, I guess, the first job is going to be identify with some precision what the assets and liabilities of the business actually are. As I say, in terms of the legals, generally speaking, an asset sale tends to be a bit more streamlined because you don't have a scenario where the purchaser is acquiring any historic problems from the target company. Where, and we'll come on to that in a minute, where there is a share sale, then it tends to be a bit of a field day for the lawyers in terms of drafting warranties. If we look at the tax or the general tax consequences of an asset sale, then clearly what's happening is Wonka Chocolate will be selling the trade and the assets to Crankies, and this leads to easy for me to say, a cessation of the trade and an end to the accounting period. we'll be in a position where if Wonka Chocolate has any unrelieved trading losses, so it's had some periods of, I guess, of shaky performance and has made a loss, then those unrelieved trading losses are generally going to be lost. If, as part of the sale, there is a property, I don't know, maybe the Wonka factory is being sold as part of the deal to Crankies, then there will potentially be a capital gain subject to corporation tax there. On the basis that Wonka's been around for many, many years, we also need to be conscious that any pre-2002 goodwill will also be in the capital gains tax regime. Of course, sale of post-2002 goodwill, along with any other intangibles, will fall within the intangible fixed assets regime. So that will give rise, if it's a gain, will give, or profit anyway, that will give rise to a trading receipt. And as I've emphasized there on the list in bold, probably the big problem, certainly from the perspective of the vendor, will be a double charge to tax. And specifically what I'm talking about there is that the disposals I've just talked about are going to create either profits or gains subject to corporation tax. But then when what's left, the goodies, the cash are paid up to the shareholder, to Sir Willie, then there will be further personal tax. So even something like capital distribution being paid on the winding up, then that would be subject to capital gains tax. Maybe after business asset disposal relief, obviously capped at $1 million, but there still will be some tax due. So the alternative route for Sir Willie is a share sale to Crankies, and I think the main advantages can be summarised quite succinctly, really. It avoids that double tax charge that I've just expressed, and as I said, it can secure business asset taper relief. That's a blast from the past. Business asset disposal relief. Which, as you know, except me, who seems to refer it to the more than one relief ago, but many of us still refer to as entrepreneurs relief. The result is that any gain within the £1 million lifetime limit has an effective rate of 10%. The 1 million limit is a shadow of its former self. If you remember, not too long ago, it was £10 million. Now, it's also that if consideration is paid by Crankies in the form of shares or loan notes, then we can potentially defer the capital gain as well. So deferred until such a time that those consideration shares or consideration loan notes are disposed of themselves. Sir Willie could also arrange his affairs such that he was non-resident in the year in which he disposed of the shares in Wonka Chocolate Limited, and as long as he remained outside of the UK for 5 full tax years, then he would escape UK capital gains tax, even though it's a UK company. However, Sir Willie is very patriotic and wants to stay in the UK, so we won't explore that any further. So, in terms of how we structure the consideration, as I've alluded to already, the deal won't necessarily, probably won't be just for a pile of cash payable up front, but some of the consideration is likely to be paid in cash. So he may receive some initial cash, and that will be taxable upfront. When I say upfront, it will become due when he does his tax return following the end of the tax year in which he's received it. Deferred consideration is often part of these deals as well, and the tax treatment there depends on whether it's ascertainable, i.e. you know what the deferred cash payment will be in the future. So it may just, it may well be he will get an extra £5 million in the future, subject to a contingency. Well, that will be taxable in full upfront as well. Or alternatively, it could be unascertainable, which means you can't pinpoint how much the consideration will be. That it is a right to receive future consideration, and that itself is a separate asset, so often referred to as a shows in action. It's called an earnout, and we'll just come to those in the next slide in a little bit more detail. The consideration could also be satisfied in shares. Usually any gain can be deferred under the share for share provisions, which create a no disposal fiction, and the base cost of the new shares you receive. So the shares that Wonka receives in Cranky, will have a base cost equal to his shares, the original shares in Wonka Chocolate. Sometimes you might not want that sort of no disposal fiction to apply, because there might be reasons you want to crystallize a gain and use business asset disposal relief. You can disapply the share for share rules if you want. Consideration may also be satisfied in loan notes, and generally, to the extent consideration is paid in loan notes, then the gain is deferred as well. The mechanism will be different depending on whether you receive what are known as non-qualifying corporate bonds or qualifying corporate bonds, but we won't go into that today. It's not uncommon for there to be a mixture of different types of consideration. So I did say we would just talk about earnouts, and I think it's important to have an awareness of them, because they're a good tool and they're relatively common, because what they do is they, I guess, are a bridge over the price gap. So a vendor will want will be looking for a high price because they know the potential of the business, whereas the purchaser may be slightly more circumspect. He's taking it. May have obviously done his due diligence, but there is an element of trust that the company is going to keep, pulling up trees and maintaining that financial performance. So he might be slightly edgier or slightly more cynical about the performance of the business. So you want to make sure that there's still a little bit left on the table from that point of view. And that's where earnouts come in. And an earnout deal will typically involve the vendor receiving a fixed sum on completion, but also a further sum which is paid later, and it might be by reference to a formula based on future business results, so future performance, and that would be an example of unascertainable consideration, because you don't know precisely how much it will be. And there's a seminal case on that, Marin and Ingalls, which is on the slide, which says that right to receive the future sum is an asset in itself, and you would value that right, and that is added, the value is added to the proceeds received by the vendor, and tax is paid on that element. So where we have an earnout, we bring into account any cash paid upfront or is deferred and ascertainable, plus the value of any earnout. So here we have the deal. His advisors phoned him and said, Cranky is happy to pay a premium due to Wonka's brand. So as I say, they're amazing how quickly everyone's forgotten about the disaster that was the golden ticket. And they're going to put £50 million on the table, but it will be structured with a mix of different types of consideration. So the 5 million cash up front will be subject to capital gains tax immediately. So let's say the deal was done today, 2022, 2023 tax year, then he'll be paying capital gains tax by the 31st of January 2024. The 5 million in shares in Cranky Pharmaceuticals qualifies for share for share. He doesn't disapply that treatment, and therefore the gain on those that 5 million consideration paid in shares is deferred until he sells his interest in Cranky Pharmaceuticals, or maybe subject to some other events. And he's also promised a further amount based on the future performance of Wonka chocolates. And when that is valued, the value of that right is 5 million pounds. If that turns out to be incorrect, then there will be potentially an adjustment. It's actually one of the scenarios, one of the only scenarios in the capital gains tax legislation where you can carry a loss backwards. So let's say he only gets 2 million from that earn-out right, then he's potentially got a loss of 3 million, which he can carry back. But Sir Willie, his mind is already going elsewhere, as we know. Advising the entrepreneurial people, holding their attention can be quite difficult. So, as I say, he's had some other ideas now. Maybe he's been talking to the twits again. There's just some further information there about business asset disposal relief conditions and some of the reasonably recent, although 4 years ago now, some of the changes to the definition of personal company, but therefore academic purposes only, I guess. So let's move on to the sale of a business to employees and key management, who are almost entirely made up of the Oompa Loompas. As it says here, Sir Willie had a meeting with his most senior Oompa Loompa, and it made him realise how loyal and supportive his staff had been through the decades and some challenging times. And it's really made him think of what good stewards they would be actually to maintain his legacy. As I say, he's not really sure about that George Cranky, who, again, there's been some rumours about him and some of his ethics around his early marvellous medicines. So the head Oompa Loompa is representing a large group of his colleagues who would be interested and deeply honoured in exploring Sir Willie's succession plan. So this slide again just shows some general options around passing shares to employees. Family business, you're going to be looking at potentially bringing in the next generation who may be employees. There are a plethora of approved share option incentive arrangements, of things like the enterprise management incentive, for instance, is a very efficient way of rewarding key members of staff, but it's probably a relatively slow process to drip feed shares to them in that manner. You could look at things like growth shares or other unapproved options, but that's, I think, more likely to be used to get your current staff to really align their interests with the business going forward, rather than a succession planning tool. Management buyouts, they can be an attractive option where you have an established business and it's already been run on a day-to-day basis by the management. Perhaps the shareholder has already taken one foot off the gas and they're looking to sort of slowly slip out of the back door and fully retire. But what I want to talk about here is in more detail is the employee ownership trust, because that is what Sir Willie has been having a conversation at the golf club about, and it seems to have really taken his fancy. So employee ownership trusts are pretty complex. There's a complex legislative straitjacket the draftsman really has been chasing shadows to an extent to make sure that no monkey business can be conducted through an employee ownership trust. And although this isn't an advert, and perhaps it's quite the contrary, I do a seminar for 3 hours on the employee ownership trust. So I've probably got about five minutes or so. So it's going to be fairly superficial, but employee ownership trusts were introduced following something called the Nuttall Review, which resulted in a number of reliefs being introduced in Finance Act 2014, where a vendor is passing a business owner is passing a controlling interest to their employees using an employee ownership trust. And I think that really just sums up, I guess, the general sort of feeling that employee ownership is a good thing, makes us also warm and fuzzy inside, basically. And I guess the next two little bubbles on that looks slightly like some kind of DNA or something like that. But the one thing that your client will know about employee ownership trusts, if they don't know anything about it, the thing that they will talk about at the golf club is the CGT exemption that they can get when they transfer shares into the trust. Well, firstly, it isn't an exemption, it's a holdover relief, but I guess for the vendor, the practical effect is that they can dispose of the shares into a trust and not pay capital gains tax. So let's say in Wonka's case, shares, he had a valuation of 10 million, but the crankies were saying it's worth 15 million. So he could sell those to the trustees, let's say for a deferred consideration of 10 to 15 million, and the trustees would be deemed to have acquired those shares at Wonka's base cost. So if he had bootstrapped the company from his spare bedroom, then that base cost could be nil, and the trustees' base cost therefore will be nil. So the point is that that historic gain hasn't magically disappeared. It's been inherited by the trustees. Now, if the trustees were non-resident and they disposed of the shares, then that historic gain may be completely washed out. But if they're UK-based trustees, then they're essentially carrying the can for any further disposal. So as I said, there's quite a complex legislative straitjacket to get the CGT relief. Some of the important ones very quickly is that the company has to be a trading company. Well, I think we're fairly safe in assuming that Wonka is a trading company. There's nothing special or any special traps there. So it's broadly, is there a trade by normal standards? One thing that can be an issue for some businesses, particularly where there's not quite the altruistic succession planning motivation, it's more about tax motivation, is that all employees must benefit, and they must benefit on the same terms. There are some minor exemptions, but here the trust must be for the benefit of all eligible employees, and they all need to benefit on the same terms. Don't need to get the same amounts, but the factors that you take into account when paying a reward must be the same. There's a controlling interest requirement, I've alluded to already, in that the trustees after the transfer need to own more than 50% of the shares. They need to control the company. So you can't, it's not relevant for 5% being transferred, but anything over 50% will do. Again, not generally a problem. The last requirement, the limited participation requirement, is probably the most challenging, and that's trying to guard against a scenario where you've got a vendor with a substantial shareholding, and that person and those connected with them make up a significant proportion of the workforce, and you measure that before the transaction and after the transaction. So in Sir Willie's case, it's probably not an issue because he's the only person within his family and works in the business with an existing shareholding, and he employs hundreds of Oompa Loompas who, let's face it, are probably not going to be connected with him for tax purposes. So he's okay. But where you have a small family business and they want to keep the shares broadly within the family, and there's probably more of a tax motive going on, then it's unlikely to work. Very quickly, the income tax points. People are often not aware that the trust can pay, the company, a company owned by an employee ownership trust can pay bonuses of up to £3,600 per year free of income tax to eligible employees. From an IHT point of view, there are no real implications either going in to the trust. There's no entry charge, for instance, and there shouldn't be any inheritance tax problems on an ongoing basis. The number of tax issues around financing the acquisition, the most common way, as I've mentioned, is for the vendor to sell the shares to the trust at market value. The consideration is left outstanding for a period, and as and when the company is making a profit, it makes contributions to the trust, and the trustees use that money to pay down that loan account. Again, I mentioned security in terms of deferred consideration earlier. You've got more flexible with general deferred consideration in the business sale. Where you're using employee ownership trust, you've got to be very, very careful with security, because if the company was to provide, let's say, a security over its shares, for instance, then that would be problematic for some of the requirements within legislation. So be very, very careful about securing the deferred consideration going into an employee ownership trust. Okay, so Wonka likes the idea of the employee ownership trust. He can sell the shares at market value. As I say, he can leave the consideration outstanding. The trustees will owe the purchase price, which ultimately will be paid from the profits of the company, and there is no capital gains tax on that disposal. He's quite happy for the Oompa Loompas to benefit from the trust. He has a daughter, Billy, but she's not really interested in the business. She's doing an actuary degree, and all his other family died in the Great Glass Elevator accident. So, there's nobody really else in the picture. But, and there is another but. So Willie's daughter, Billy Wonka, has just finished university now, but unknown to Willie, she changed her degree to one in ESG, so all things green and social, and she specialised in ethical confectionery. And Willie didn't know this. You might remember, as I put there, last week's headline in the Daily Mail, Wokey Wonka, which was about Billy Wonka, and that brought this to Sir Willie's attention. His daughters approached him, and she's starting to feel a bit uneasy about the Oompa Loompas conspiring against her and trying to edge her out of the picture. So Sir Willie's pleasantly surprised that she's interested, because he really thought she was going to be an accountant. But Billy's never been great with money. She's not had a great choice in relationships. She's not been very good in relationships, and so Sir Willie is wary about giving her the keys to the kingdom outright. I think I need another coffee. So he's a bit wary of that. So there are a number of approaches here to perhaps bringing in his daughter in some capacity. The first one on there, an outright gift of shares to Billy, is the simplest route for CGT purposes. As Billy's over 18, they can use holdover relief, a joint election, such that Billy effectively inherits both the shares and Sir Willie's historic gain. So the mechanism's a little bit like I discussed for employee ownership trust. So, you're kind of saying, yeah, you can have my shares, but I'm not paying a capital gains tax. You can pay that later on. For inheritance tax purposes, it's highly likely the shares are going to qualify for business property relief for IHT purposes. It's a trading company, it's unquoted, and therefore on a transfer, either in lifetime or on death, there would be 100% relief from IHT. But, you know, as tax advisors, tax isn't the most important thing in the world, but don't tell everybody. It doesn't satisfy Sir Willie's objectives to give her the shares directly. So that brings us to trust, and fundamentally, so we've got a few minutes left now. I'll wrap it up in a minute. But fundamentally, this is where trusts are used for vehicles. But they're not, despite what the papers may say, they're not really a tool for tax avoidance and haven't been for some time. They achieve the same effect as an outright gift, but through the trustee retain some control over at least the underlying capital. So here, Sir Willie would transfer the shares to a trustee for the benefit of a discretionary class of beneficiaries, including Billy and any children or other family she may have. The trustees would be legal owners, and they would control the shareholding, albeit, you know, for the benefit of the beneficiaries. This might be preferable to giving Billy a life interest because it's more likely to be robust, not bulletproof, but more robust against financial predators. So Willie is already protecting Billy from a divorce, and she doesn't even have a boyfriend or girlfriend just yet. So again, not uncommon for sort of your parents with wealth to be thinking that way. Again, holdover relief would apply for capital gains tax purposes, and importantly, business property relief would apply on the transfer to the trust, because as you may or may not be aware, generally speaking, if value over the nil rate band goes into a trust, then there's an immediate IHT charge. BPR essentially protects us from that. It will protect us from a 10-year charge, and it will protect us from an exit charge. Of course, trust is more complex than an outright gift. I'm just very quickly going to run through family investment companies, and I'll wrap up. A family investment company is perhaps flavour of the month or year or two, and is an increasingly popular alternative to a trust for wealth planning. But generally speaking, they're more likely to be used in a scenario where using a trust would result in an expensive IHT entry charge on value going into the trust. So a scenario where business property relief isn't available. So I think Sir Willie's more likely to use a family investment company after a trade sale. So for example, let's say he'd sold the business to Cranky's, and you know, he's finally got himself out from that tyrant George Cranky, and he's sitting on £15 million worth of proceeds. You know, clearly there's whether there was some tax to have been paid on that, and he wants to invest that money in assets, perhaps crypto. I think the Oompa Loompas got him interested in crypto a few years ago, so he would like to build a portfolio around that. Because once you're sitting on cash or non-trade investments, then you've gone from a very inheritance tax efficient position, you know, 100% BPR, to a completely exposed position. So he sets up Wonka Investments Limited. He retains 20% in the company. Billy will own the balance, or they could be those shares could be held on trust for Billy's benefit, with that asset protection objective in mind. So Willie funds the FIC with a loan of £15 million. He retains day-to-day control of the portfolio by being the sole director. It may well be that in later years the plan is to bring Billy in some point, so she gets used to managing the portfolio. But the key point is that the majority of any growth in the value of the company will accrue to Billy rather than in Sir Willie's estate. His shares, so the value of what he's retained, is also likely to benefit from a significant minority discount as well. So will be less than the net asset value of the underlying assets, perhaps. One day, he might assign the loan he's made to Billy, so the loan he's made to Wonka Investments Limited to Billy as well, and that is likely to be a potentially exempt transfer for IHC purposes, which he'd need to survive by 7 years for it to fully fall outside of his estate. And I think that's me done. That's a wrap. I think pretty much on time, maybe 90 seconds or so over. But if anybody has any questions, I think you've been firing them into Mark. But that's me done otherwise. So thank you for listening.
Brilliant. Thank you very much, Andy. Really appreciate that. Yeah, we've got a couple of questions, and I know that there will be some that you answered within the presentation, so just remind me as they come up. There was a hell of a lot to take in. Somebody did ask on the call as well if it's going to be the recording is going to be sent out. As always, we will send the recording out. We'll hopefully get that out to you tomorrow. There was a couple of questions around tax planning and when you need to start. Probably my personal favourite is, because I think it will get the best answer, is there ever a time when it's too early to exit plan?
I think you're better off being too early than too late. I think that's probably the first point. I think knowing entrepreneurial folk, I think you're more likely to have somebody who doesn't really plan at all than somebody who has been agonizing over it for maybe half a decade. And I think there's a saying that once you start thinking about selling as an entrepreneur, you probably should have sold already, but that's obviously the kind of sort of fluff that you get in some of these sort of biographies and self-help books, isn't it? But I don't think I think if you're looking at I think it depends on what you're looking at. I think if you're looking at a trade sale, I think perhaps having a concrete plan 5 years before sounds a little bit early. Clearly, you may be over the long term building your business with a notional sale in mind. I guess the reason why many people leave employment and set up businesses is they want something which outlives them and has some capital value, don't they? And it's certainly why I started off in business. So thinking along how you're bringing in staff, you're bringing in other work and things like that to grow the business, such becomes more valuable and more attractive. You're kind of doing that all the way through, aren't you? So I'm not really talking about that, but in terms of thinking, right, okay, we need to start marketing this. I think really for me, you want to be looking at maybe 2 years out and then taking those steps to perhaps tidy up the balance sheet, really perhaps taking a different view at how you run the business. Because again, when you're in that early growth stage, you may be reinvesting quite a lot into sort of things that will only have a long-term benefit. If you're going to sell in 2 years, are you really going to be? Do you really need to be spending things on something that will only benefit in 5-10 years? Well, actually, you might want to look at cutting that back so you're increasing your earnings. I think in terms of maybe if you're looking more down the employee or the family succession route, that can be, I think the time frame for there is probably much longer. And again, I think you're going along as a business owner, you're always looking for that person, whether internally in the firm or externally, who you think is the person who takes over the reins from you. So I think that's slightly different. And again, if it's a family business, there's always that, are they really a chip off the old block, kind of bringing them into the business, maybe sending them away to get experience elsewhere. And that probably is a very long-term plan. Sorry, I don't know whether that even answered the question at all.
I think so. No, that's great. Thank you very much. We've got another couple. I mean, we've got one from Nick, which is I'll answer. What are your charges? The best thing to do is Michelle will pop in very shortly the contact details for Pete. And if you have a conversation with Pete, I think obviously it's a very ambiguous question to be able to answer. Depends on what work it is that you're going to be doing for each customer. So I would say that's always good. But yeah, if you have a conversation with Pete, we will make sure that you can get the details from the chat box. There's Deepak says, what happens to the cash within the business?
Well, I think I may have touched upon this in the content, but I think generally speaking, if you're selling to a third party, they're not going to be interested in acquiring a load of cash. So again, as part of that sort of tidying up the balance sheet, you may well be looking at a pre-sale distribution. That's usually the case.
Yeah.
And the same would apply if you've got, I don't know, there's some random property investments in there as well. You're not going to be looking at sort of the purchaser isn't going to be looking at acquiring those either. So again, you may, if you're looking at taking a long-term view at this, it may well be that you're looking at perhaps a slightly more complicated pre-sale sort of reorganization. So you're splitting the trade and any investment assets into two. So some kind of demerger, for instance, a pre-sale demerger, such that you've got the assets that a potential purchaser is going to want to buy separated from, it may be valuable, but the purchaser doesn't want to buy cash, and some buy-to-let properties in Warrington or something like that, for instance. So you don't want to call the buy-to-let houses in Warrington chaff, but you're separating the wheat from the chaff.
Brilliant, thank you. John's asked, what protection can you put in place to protect deferred consideration?
So securing that deferred consideration, I think, is something that comes up from time to time. I think, generally speaking, I think it's common, it's reasonable, it's understandable for there to be some kind of security or charge for deferred consideration. Clearly, you're still, I guess, assuming that the company is going to carry on, not completely go down the pan after you've sold it to the purchaser, but you would at least want to be securing that deferred consideration and make sure that you actually get it. Because the longer the deferred consideration, perhaps the more sort of precipitous that is. I think I did mention that employee ownership trust, you've got to be very, very careful, because in that scenario, what you might expect is that I've sold to the trustees. I think in that case, it was for £10 million. It owes me £10 million over the next 5 years. I'll take a charge over the shares, the trustees' shares in the company. That would almost certainly foul your employee ownership trust relief. It wouldn't satisfy the requirements. You've got to be very, very careful in that scenario.
Brilliant, thank you. Williams asked, if Wonka was a non-trading company, e.g. buy-to-let property company, are there any magic bullets or preferred routes?
Was this for any particular tax? Was it inheritance tax, capital gains tax, or? I mean, first and foremost, there are no magic bullets. Well, if you know of any, send them to me. I'll be interested in hearing them. But it's tax. I say this as a tax advisor, and say it grudgingly, but tax isn't necessarily the most important thing in the world. So it would be essential to find out what their personal commercial goals were. So what are they actually trying to do? Is it, are they trying to sell the portfolio? Are they trying to pass it on to the next generation? Are they trying to take funds out in an efficient manner? Is it already in a company, or is it held in their own names? It's very, very difficult without knowing the circumstances on the objectives. But going back to the question about charges, to be honest, if somebody phones up or gets in touch, we're happy to have a chat about particular circumstances. We're not going to charge for it unless somebody wants to explore it further. So I'd certainly recommend that people get in touch if there's a particular case like that. Sorry, it's a bit of a politician's answer, but I'm not sure where to start with it.
No worries. I think this is going to be the same one. So Tom has asked a question, and bear with me because it's a long one.
There are, certainly for an IHT, an IHT point of view, which I don't know why, but I kind of got the impression that maybe that was.
It was CGT and IHT just added.
IHT, there are things that you can do, obviously, and he's right to the question. The person posing the question is right to sort of certainly imply that you don't get business property relief on the property investment portfolio. You don't, even if there's a business. The very it's very badly named business property relief, because you might think, well, if there's an investment business, I might get business property relief, because you can get, if it's an investment business, you can get incorporation relief, for instance. But you have to be more than a business to get business property relief. You effectively need to be trading, and property investment isn't a trade. Property development is, but investment isn't, so you won't get business property relief. But there are other things that can be done.
Brilliant. Okay, thank you. This might be a have a conversation afterwards, but Tom has asked if Wonka share sales was the £500,000 being 450k up front and 25k at end of year 1 and 25k at end of year 2, but the purchaser refused to pay year 2 for no reason other than they didn't want to, and it's considered a bad debt. Can you adjust CGT comp for a bad debt?
For me, I'm not an accountant. I'm a lawyer. So first of all, there were too many numbers there. But in principle, if you subsequently don't get the deferred consideration you were promised, and you can convince HMRC that you're not going to get it, then you can. So it's not about technically adjusting it. You essentially have a capital loss that you can carry back, and that will then, I guess, practically will be an adjustment to the original tax return. But I think the answer is yes.
Brilliant, Tom. If that hopefully that answers your question. I didn't read the last bit out, but I think that hopefully that will give you some idea. I would guess by the way it was written, there is a particular instance in mind for Tom, so perhaps he can give Pete.
Sound 100% hypothetical, didn't it?
And there's just a couple of others. We've got a bit of time for a couple of others. Atix asks, what is the most tax efficient way to sell a business to a third party?
So I think as from the vendor's perspective, if we're talking about, I guess, normal circumstances, selling the shares is going to be the most effective. Clearly, if you can get a dollop of cash up front, and you still got some business asset disposal relief left, then let's say it all falls within the £1 million, then the rate is going to be 10% for not a great deal of effort, not a great deal of restructuring, not a great deal of professional fees. Let's face it. So that is a good route. I think you've got to bear in mind, as I said earlier, the purchaser might be agitating for an asset and business sale, but whoever is in the stronger position will prevail. Clearly, if you want to really sort of turn your life on its head, as I alluded to previously, you can take quite drastic steps by becoming non-resident. But you need to be non-resident for 5 years, and it's stating the obvious that 5 years is a long time. So I would never, as a purely tax motivated suggestion, say to a client, just become non-resident, you'll be okay. I think that I never had a client who did become non-resident, lived in Geneva for a while and is in Barbados now, and I think his gain was several £100 million, but he wanted to go and live overseas and have an adventure after building several businesses. So he's really been enjoying life. As we said, his family has remained in the UK, so perhaps that's why Mrs. Wood isn't listening, I hope, but maybe that's why he's taking
I'll send her the recording.
Oh yeah, it's recorded. Can you redact that, please?
Brilliant. One last one before we finish, which is bang on. And if anybody that hasn't got any other questions, as I say, the information for Pete is in the chat box, so please copy that out. Pete will be delighted to receive your call. And I'm guessing the answer to what is the best way to transfer a business to employees is by the employee ownership trust.
Assuming if the planets align, it is a very efficient way of doing it. So there was and it's in the public domain, but there's a really good case study and some reports in it by the chap who owned Richer Sounds, Julian Richer, who transferred, obviously it was a controlling stake, but I think maybe 60-70% of the business to an employee ownership trust. And he was happy to do that because, as I perhaps alluded to in this case study, if anybody's seen his book, I think it's called The Ethical Capitalist. So he's certainly a little bit, let's say, left of centre in his, I guess, his political leanings. And he was very, and he's run his business in a very socially progressive way. He wanted it to be carried on beyond him, so it was his legacy. And his main fear was that private equity would come in and gut his business. So for him, the employee ownership trust route was a good one. But you almost have to have that sort of altruistic mindset, because you really are passing this on to the employees. If maybe this is more about my clients than anything else, but my client's going to be, and they're saying, well, I can sell it and not pay capital gains tax. You're on the back foot there, trying to satisfy, I think, the requirements in that scenario, and particularly in a family business where they want the family to carry on holding the shares. It's very, very difficult to make work.
Brilliant. Well, thank you very much, and thank you very much for joining us, and thank you to everybody who's asked questions. It just leaves me to say, again, thank you, Andy, for delivering the presentation and sparing your time for the community. With the recording, will go out to everybody, but until next time, we'll see you soon. Thank you. Thank you for watching our webinar with Andy Wood from ETC Tax, where Andy was talking about the tax considerations for your clients when business exit planning. Andy covered the top 3 main routes to exit planning, and I'm sure you'll agree it was lots of information for you to be able to watch back and see exactly what he was talking about during his presentation. So if you have any questions, please comment below. Alternatively, like the video. And if you want to hear more from us, please subscribe to our channel and you'll be notified when we next put up a video. You should be seeing on your screen around about now, somewhere here, the videos that we recommend you watch next to inspire, challenge and support you to be the best practice you can be.